Thanks, Henry. The first thing I'm going to go through is a little bit of the capital budget. This is the budget that we announced in November. $530 million. You can see where that gets spent in terms of regionally. I will say, just in terms of characterizing this is, I'd say, two things. It's aggressive and it's flexible. Those are kind of the two words that come to mind. It does assume that everything in Kurdistan is going well, and therefore that $370 million that we've got set aside, we're spending. Now, if things don't go as well in Kurdistan, I'll take you through that. It also assumes that there is appropriate financing available, and I'll come back on that in a second. But just sort of overall, a hauler, we're spending about 70% on hauler and 60% on drilling. So this is a little bit more detail. On hauler itself, just in terms of where we are spending the capital and what we're sort of focused on. The first thing that jumps out at this is it is focused on Demir Dag, obviously reflective of some of the things that we've talked about earlier and the program that Henry talked about. Roughly, of the $370 million, roughly $260 is on Demir Dag. And that breaks down to about $90 million in that appraisal program that Henry talked about, so to learn more about the field and potentially start looking at reclassifying some of those contingent resources. There's also $170 million in full field development, and you can see the components of that. That's that category called DD development wells. That's roughly 5 wells. If you think about that just in terms of then sort of what productive capacity is, we are basically between DD2, the 3 appraisal wells and 5 development wells. We'll have 9 producers by the end of the year. That's what this budget says. We've also got this 3D seismic program in here as well. We've got roughly $60 million of the permanent production facility in here as well. That permanent production facility total cost will be $250 to $300 million. Again, roughly $60 million will be spent in 2014. The other $100 million of that 370 is appraisal of other discoveries. And the one thing just to mention, I think a few people were surprised at the size of our capital budget, but guess what? When you make a discovery, you've got to come back and you've got to do some appraisal. You've got to do more work. You've got to spend more money. So, frankly, it shouldn't be that much of a surprise. We do have budget for Zegara and Al Safra, both in here. And you can see this little bit of start of a Benin appraisal. That may be a little optimistic at this point, but we do have our fingers crossed that we will know we'll be spending that, at least that amount, next year on Benin. So that's really the hauler capital budget. I'm not going to go into too much more detail on that. Non-hauler, now looking at the rest of the portfolio, I'd say this really highlights a couple of things. One is it is second half loaded. Call it mid-year to second half of the year. And it highlights 2 main components that we were talking about earlier. And these are material wells that we'll be drilling in the AGC and Oatmare B. We'll come out, obviously, early next year, with additional information about these 2 wells. We would have loved to have stood up here today and given you all sorts of numbers and additional information on those. The reality is that's still being worked on, and so that's something that we're going to come out with next year and give you a little bit more guidance on that. The rest of it, basically then is a little more work in Oatmare A, as well as seismic programs, both in Nigeria and Wazit. I'll show you this chart, and the first thing I will say about it, it's a production profile. It is illustrative, and Greg, don't look at each one of those, periods and say that's exactly when we're going to hit those production targets. So it is purely illustrative. What it does, though, tell you is, A, there are going to be step function changes in our production profile, and this is just Demir Dag. The first thing is really, first production 2014, and then ramping it up. And you can see this is a summary of what we've told people previously in terms of our production milestones. So that's sort of one kind of milestone. 2015, hitting a target of 40,000 barrels a day. 2016, hitting 100,000 barrels a day. This is tangible. This is there. We heard sort of Henry's presentation. this morning. Everything that we're doing, all of the activity is focused on this, and this is something that's real. It's not sort of hypothetical development type plans. So that for us is obviously very important, and it is a big area of focus for us. Just very simply put, 20,000 or the 2014 milestones. If you look at the sort of the average guidance that we've given, that's 8 to 10,000 barrels a day. We're quite confident that we'll hit that. And the other two, 2015, in terms of when we hit that 40,000 barrels a day, I'd say it's probably going to be earlier than mid-year. It's going to be first half of the year, and likely, with 2016, as we get closer, we can give you better guidance as to better timing on both of those. And just to add here as well, we've heard the story about the contingent resources. This is only our 2P reserves. Contingent resources are more than twice our 2P reserve book number. That has the potential to materially add to these numbers. And whether it's 2016 or slightly beyond, it does have quite a big impact and is a very important factor to understand when understanding our story. So what does that mean sort of from a fiscal perspective? These are the fiscal terms of the hauler PSC. I'm not going to go through this in gory detail. I think most people have access to this already. It is a straightforward PSC, though. There is a royalty that's 10%, cost recovery limit 40%. R factors go between 14 and 28%. The one thing that is different is the capacity building payments. We do have a lump sum capacity building payment on first commercial discovery. I'll come back on that in a second. And then we've got basically a percentage of our profit oil that we're paying out based on where we are in our cost recovery. A couple other points that we've made on the right side here. All the government back-end rights have been exercised. Our 65% is our 65%. We do, however, carry the KRG, so we're basically paying 85%. We'd also pay 100% of the capacity building payments. We do have other contingent consideration clearly disclosed in our financial statements. First commercial discovery, and this is to the vendor, $20 million. Second commercial discovery, Henry mentioned this earlier, $71 million payments that we'll be making. Last point, though, I will make on this slide, and it does come back a little bit to sort of, Jerry, your question earlier about economics of Anil Safra. There isn't any ring fencing of costs on this project. So anything that you throw in at Anil Safra, exploration at Zagara, is all cost recoverable against the production on the block. So that makes a pretty material difference in economics, just to point that out. A couple other things. So netbacks. So what does that mean? We've given basically netbacks on $60, $85, $110, depending on if are we selling locally, are we selling internationally. Just very briefly, I'll go through the $60, 10% royalty, $6, so that's $6, easy math. Cost oil, 40%, again, pretty easy math. Contractor share, and these are near-term netbacks, so 14, 15, 16 maybe, depending on, again, what the oil price is. Contractor share, roughly $9 profit oil. You put those together, contractor cost oil and profit oil's just under $31 on a $60 realized price. OPEX, we've got we would estimate, including transportation, roughly $4 a barrel. So therefore, the contractor netback is just under $27. Then there are a couple of, I'd say, things unique to Oryx Petroleum. Mentioned these on the previous slide, but just to go sort of through the math there. You've got the capacity payment, so this is 15% when the R factor is below 1 of our profit oil. So that's just taking 15% multiplied by the contractor share of profit oil. That's what we pay per barrel as a capacity payment. We also then, and one of the parts of the PSC that is unique, is that we do carry the KRG CapEx and actually OPEX up to $300 million. But this is recoverable from the KRG's share of cost oil. So therefore, we carry the KRG's share of OPEX. Effectively, what that 30.8% number is grossing the KRG's 20% down to basically our 65%. So it's actually the 30.8 is 20 divided by 65 to get it back onto a per barrel number. You take that 30% multiplied by $4, so we're basically paying for every barrel, every one of our barrels, we're paying $1.23 of the KRG's OPEX. The flip side of that is we do recover their share of cost oil. And their share of cost oil, again, on a per barrel metric for us, it works out to $6.65. It's the same ratio of basically the 20 over 65 times the cost oil. So we recover that. All in all, then when you take that all into account, the netbacks that Oryx Petroleum gets, again, near term on a $60 price, we're getting about $31 a barrel. At $110, we get about $61 per barrel. Now, the interesting thing with this is we get about 60% of an increase, general terms, increase or in the realized oil price. You can look at it the other way as well, which is this actually provides us a little bit of a buffer that, if the realized oil price goes down, call it $50, the impact to us is not dollar for dollar. We get shielded in an oil price environment that is potentially dropping as well. So, haven't gone through sort of the numbers, but I'll drop the hint that you can look at the previous page and this page and do some math yourself, and you come up with some pretty interesting numbers, both 2014, 2015, and even into 2016. Just a couple more slides. Financial statement items, one of probably the most exciting topics of today. I'm only really going to concentrate on one of these, and I do want to point this out because it is a common thing that gets lost in our financial statements. Those contingent payments that we make to the AAR, or the vendor, and the KRG, $141 million worth, sits on our balance sheet, and it's an IFRS treatment of all of that. And it shows itself out basically in our trades and accounts payable. The fair value of that today, reflecting commercial success and the time value of money, $126.7 million. That sits as a liability on our balance sheet. And just to sort of make the clear reminder of that, if people are assuming that in their models that we're paying these bonuses and then taking it off when you look at our balance sheet as well, just something to keep in mind that that's double counting. Probably, two more slides. So now looking at, I said I'd come back on liquidity and the funding part of the business. We've got a chart here that graphically shows basically our cash flow, our cash balance beginning of the month and the CapEx spend that we're planning. Couple of things here is our CapEx, as I mentioned again, is weighted to the second half of the year, roughly just over $200 million spent in the first half of the year, the balance being $330 being spent in the second half of the year. This is kind of a funny chart, though, for us to put up here. And because it is a funding scenario, that means we're not getting any cash flow, but we're still spending everything that we've put in that aggressive CapEx program. And so it is, for us, almost not a realistic scenario because we will scale back our CapEx if we're not getting any cash flow. That for us is pretty clear. So this is a worst-case scenario. And unfortunately, I think a lot of people view it as a base case. We do have minimal work commitments. So again, our capital work program, while we say that, while we're looking to drill a well in the AGC, we don't have to drill that well until 2015. So, from a minimum work commitment, again, we've got the flexibility to change what we're going to spend on, and we do have the ability to even slow down things in Kurdistan if things aren't going well from an export perspective. In terms of, I guess, the second part of this is the funding gap that we do have in the second half of this year. Again, this is not a surprise. We told people on the IPO, Mike made the comment earlier today, we're funded through the first half of this year. That is our program, our CapEx program is funded. So this is not a surprise. And the magnitude, the more discoveries you have, the more capital you need. Again, not really a surprise. Potential sources of capital. So again, I mentioned this does not assume that we have cash flow coming in. And from a financing perspective, we're not really assuming that in our plan. We don't know whether we'll be selling domestically, internationally. That will be coming out here, hopefully in the next quarter or so. Another area, debt financing. This, for me, goes hand in hand with cash flow. We are in, I'd say, advanced discussions with some of the lending banks, looking at different types of debt financing structures. That's a possibility, and I'd say quite a real possibility in terms of looking at filling that funding gap. The last one, though, and I think a lot of people are, a lot of other companies are nervous about this, but are talking about this. For us, it's kind of evident. We probably will need more equity, just flat out, most likely. The timing and magnitude of which I can't tell you, because that wouldn't work with securities laws. But also, we just don't know today. Timing, though, I think you can all make your assumptions on that. The other thing, though, that I will say, and it comes back to a point Henry made, is we do have this light blue bar. These are the payments that are due to the KRG. This is $70 million in total to the KRG and to the vendor. These exceptional payments, the timing of those is uncertain. We've put them in Q3 because that's really, I'd say, the end of the appraisal program, and this is typically when you declare commerciality. There is a potential, as Henry mentioned, that if we do see real prospects of getting real cash flow, and we do want access to those cash flows, we may be accelerating these payments. So just a heads up there. This is my last slide, and it's one of my favorite slides, actually, in the whole price deck, or in the whole deck. I think the conclusions from this are pretty obvious. I'm not going to spend a lot of time on it. I will make a couple of observations on it, though, and this is your typical comp table comparing us to others. This is using street research. This is using average of street research numbers. We have not cherry-picked for any of these numbers. That's my first observation. Second observation, but I think on any metric, if you look at us, price to net asset value, price to RENAV, versus what I would say are some of our peers and some other companies operating in Kurdistan, well, I think the message there is pretty clear, and we're obviously working hard to change that. The other thing is, and there's all sorts of subjectivity everybody knows in terms of going into net asset value calculations. So if you look at it on an EV to 2P basis, which is one way of looking at it, okay, yeah, still a significant discount. We're not producing today, but we will be producing here shortly. EV to 2P and 2C, that should say 2C basis. The interesting thing there, again, critical to our story is understanding the C's in our story. I've never actually seen anybody risk. People will risk on an NAV basis. They will risk contingent resources. I've never actually seen somebody sort of risk the barrels, which would be quite a fascinating exercise to do the same math. And if you've got gas in your contingent resources, or if you've got heavy oil that you have not been able to flow to surface, and you make these kind of adjustments, I think we look even cheaper. Same kind of adjustments you'd make on a TRR, but again, even on a TRR calculation, I don't really see anybody making adjustments to contingent resources. So that's, I guess, probably the last thing to point out is we do have $1 billion of equity in the company. That should be, for me, pretty telling, just in terms of our current valuation. So with that fun slide, well, thank you very much. I'll pass it back on to Mike.
Thank you, Craig. Let's see if I've got a slide. Yes, I have one slide left, and I'm just going to give a few closing comments. And I think the message has been clear today, but I might reemphasize one or two key points. We are quite a conservative organization with quite a conservative reserve auditor, and you hear Henry being very careful and very hedging, so I'm going to make a couple of simple type statements. We sit on a block in Kurdistan that has a hell of a lot of oil on it, and that's an easy sort of statement to make. And this will be something which will give us years of work to increase our reserve base. And Henry's talked about Pulaski, the Nejma, the deeper plays, and so on. There's stuff that are in none of the numbers we've shown you that we'll be going after, as I say, 4 years to come. It is a huge growth block for us, and it's a fantastic base for a company. The second thing I want to tell you is Banan, obviously that is close to TD now. We'll be testing in the new year. Henry, again, was very careful. All I can say is there's a lot of buzz in our organization about that well, like there was a lot of buzz about Demerdag. That doesn't give you any guarantees, but and certainly Henry talked about potential size of structure. So it is something we are all extremely excited about and looking forward to. My one regret in life is that the end of the year isn't end February, end March, because it always seems like our really important stuff happens in Q1, but we find ways to deal with that. Thirdly, and importantly, in the short term, we are appraising up. Again, we've shown you some nice 2P, some nice 2C, 3C, 3P numbers. We go into Q1 and we're drilling a lot of those appraisal wells, and then we start to get to production. All of that should help pull things into the reserve category. So it is certainly on a go-forward basis. We sit on a very rich resource base and one that will grow as we go into 2014 and will continue throughout the years thereafter. We do have, on top of all of our Kurdistan play, we have some big upside in 2014, in particular the AGC well. I say in particular AGC because, as Henry referenced, we have 80%. We are operator. We're driving that process. That's one we're quite hopeful on. And we still sit as a player in Nigeria and a player in Iraq and looking at the longer-term potential there. We have a very good team. We sit in Geneva. Craig referenced it. We have a supportive major shareholder. Jean-Claude is a huge fan of Kurdistan. He's a huge believer in that things are getting sorted out and moving in a positive direction. He obviously thinks we are dirt cheap, and so that's hence part of what Craig is saying is we would put money, he'd put money into, if it's going at this current price, to support it and make sure he doesn't get diluted down too much. So it is, we sit here today in quite a strong position in terms of being able to find ways to finance ourselves and tap into that further growth. I'll thank you all again for taking the time to listen to us and wish you